Welcome back to the Lucia Capital Group weekly video. I'm Rick Plum. Have you ever looked at a dividend yield of a company and noticed that they seem to be paying a lot more than others of a similar class of stocks? It probably looks pretty attractive, right? After all, who wouldn't take a 10% dividend yield over, say, a 4%? But be careful. Double-digit yields are often an indication that the market doesn't believe the current distribution is sustainable. Anytime you have a situation where you're being rewarded more than what the market currently offers on average, you need to be a little suspicious. Remember, yields go up as investors perceive more risk, so they need to be compensated for that risk in the form of a higher current return. So in some instances, a high dividend may be a signal that all is not well with that particular company. For example, let's say a stock is trading for $100 and it pays an annual dividend of $5. That's a yield of 5%. But then something happens to that company, causing its stock to go down by 50%, and it's now trading at $50. If it's still paying that $5 annual dividend, that means the yield on the company's stock is now 10%. High yield, but the company may be in trouble. If you just walked in the room and saw that 10%, it may look great, but you have to look deeper. This is where the details matter. Ask some questions. What business is this company in? And what is the asset class? If you're investing in corporate junk debt, you'll demand a higher current return than investors in investment-grade corporate debt. And where has that stock traded historically? If the yield has never been in this range before, something could be seriously wrong. Or maybe the entire business type or asset class has been repriced in the market. In these instances, a company has a couple of resolutions. They can cut the dividend, although oftentimes that causes their share price to go even lower. Or they could just try to keep the dividend payment flowing, even though the profits aren't there to support it. Maybe they're selling off certain assets or working on ways to reduce costs. But companies that do that often reduce their ability to make future profits as well. Either way they go, they're running some kind of risk. The takeaway here is that you should always look behind the curtain to find out what's really going on. You've heard the expression that if something sounds too good to be true, it probably is. That's a really good thing to keep in mind. If a company is paying a 13% dividend when everybody else is paying 3 or 4%, something's wrong. Quality very rarely trades at a double-digit yield. Read the prospectus, check the financial statements, do your homework, and find out what's generating those high dividends. If it isn't coming from profits, you could be taking on more risk than you bargained for.